Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
Other jobs outside the tech sector, we've spoken about Meta, Walmart, Morgan Stanley, all cutting jobs, mostly in the management C-suite seems to be where that those cuts are being felt most. The other big phenomenon of the week has been really an acceleration of this bond sell-off story with respect most definitely in the longer duration bonds, whether it's 10-year or 30-year. We have a 10-year chart here on the top left and a 30-year chart on the bottom right. In the case of Treasury yields, highest level in more than a year when it comes to 10-year US government bonds. And then across other developed markets, we're seeing long yields, so at the 30-year at their highest in decades, led in this case by gilts, which, as we know in the UK, have been really bearing the brunt of the political uncertainty in the UK. We're also seeing, though, that Treasury yields, JGBs, all at this time reaching a higher level of sell-off. So the last time we've seen this type of a sell-off in gilts was back around the financial crisis, predating 08. This would be around the beginning, around 98, 99. The equity market, too, is certainly shaping up to be an unusual one. We've spoken about how the stocks, particularly in the US, have generally rallied as news flow around the war has developed. We have seen the European stocks suffer much more than the US stocks. And if we look at a chart that compares stock movement with bond movement since the war, we can see that stock movement has generally shown a recovery, pretty solid recovery, and actually much more increase as we move through the uncertainty of earlier in the year, which, as we know, was relatively flat as it was anticipating some uncertainty relating to the war, whereas the Bloomberg Ag has also been ticking along fairly steadily. The semiconductors, on the other hand, have been the absolute breakout trade here. There has been, if we look at this, we've seen that they have really taken off as the infrastructure trade in the aftermath of much of the sell-off. But we can also see that the S&P itself has behaved quite respectably, but that there has been a story of a breakout trade within that sector. We're still referring back to the CapEx number, as this is something that is really extraordinary in terms of AI demand. So we do know that the AI demand is surging, but that across the board, we are now looking at hyperscaler CapEx, which could exceed 1 trillion in 2027. This is really the new calculus in terms of what companies need to have in reserve if the expenditure goes as we have expected. We can see that Alphabet, Amazon, Meta, Microsoft, these are all huge consumers of CapEx and users of CapEx. So we can see that this is likely to be a factor that is increasingly dramatic. Even though 2026 was already high, we can expect it to be even higher next year. This is the chart I was referring to earlier when it comes to the intersection between the cost of CapEx and the cost of people. This chart shows Alphabet, Meta, Apple, Microsoft, so 4 of those large companies that appeared in the previous chart. And we can see that even at this point, we can already see that the cost of people, as expressed by the blue line, has now already started to get flat, and CapEx has significantly overtaken that. So we do also know that the cost of the recent layoffs, particularly in the case of Meta, are quite insignificant when it comes to the CapEx spend that they have committed, when we can see here that the amount that Meta has committed is well in excess of 100 billion. It's expected that they will save approximately 8 billion from some of their current people cuts. So clearly not really making a dent in that CapEx spend. And this will be a new calculus that companies need to consider versus how expensive their people are versus how much they're likely to spend on CapEx. And what will be seen is whether other factors will also be cut as CapEx continues, or will CapEx be reconsidered as there will be a desire to see return on investment in the AI.